We're glad to have you on the program. Thank you for joining us. I am Bisi Adebayo. Today on the show, world stock markets hit record highs on the first trading day of the new year. South Africa fuel prices kick off 2021 with a hike. And Egypt's central bank extends debt relief initiative due to a virus. Well, let's kick off the show with intraday market numbers starting in Africa, where the Nigerian stock market is kicking off the first trading day in the new year on a tremendous high with an increase of close to 2% at about midday. It's the same story in South Africa, where the JSE index surged 1.3% also at intraday. On the flip side, the EGX 30 was down 0.12% at intraday. The Kenyan Bourse is yet to resume trading in the new year, but the market closed 0.76% positive on Thursday last week. And in the Middle East, the markets are also getting off to a bright start to the new year as all the major indices we track in the region were all in the green at intraday. The Abu Dhabi index was up 0.72%, while the Dubai FM was also up by a whopping 2.9%. In Qatar, the index was 0.38% positive, while the Saudi SE was also 0.55% in the green. It's not any different in Europe. Stocks advanced this morning in the first trading session of the new year. But Chelsea Delany will be telling us more about what's shaping the markets in just a moment. But before we get to Chelsea, let's see what's happening in Asia. Of course, the numbers are also in the green. Most of the markets were higher on Monday, the first trading day of 2021. The Shanghai Composite gained 0.86% to 3,502.96. While the Shenzhen Component soared 2.466% to 14,827.47. Elsewhere in South Korea, the Kospi jumped 2.47% at 2,944.45. Japanese shares lacked the broader gains in the region as the Nikkei 225 dipped 0.68% to close at 13,091.64, while the Topix index shed 0.56% to end its trading day at 1,794.59. In Australia, stocks were also up, with the S&P ASX 200 1.47% in the green, closing at 6,684.2. All right, Chelsea Delany is ready for us. She's reporting live from the Frankfurt Stock Exchange to tell us how the first trading session of the new year is doing. Happy New Year, Chelsea. It's good to see you again. This is 2021. And we can see that the first trading day of the year, many indices, including the DAX in Frankfurt, where you are, starting near record highs. What do traders think is in store for the markets this year?
Well, Happy New Year, and investors are expecting another strong year for global stocks, and that's after an already record-breaking 2020 where we saw many indexes, including the DAX, hit record highs, have huge double-digit gains over the course of the year, and particularly since the brutal March sell-off as the COVID crisis began to unfold. All of that does seem to be continuing on into the new year. The DAX has started up about 1%. We're seeing other indices around the world also starting quite strong. And really the backdrop, investors say, is quite supportive, even though many countries do continue to struggle to contain the virus, even though the vaccine rollout is moving quite slowly across the world. We do see the economy starting to rebound. There is a lot of hope that we will see really strong growth in economies, especially starting later on in the second half of the year as the vaccine rollout begins to pick up speed. And as well, we still have a lot of central banks and a lot of governments providing an immense amount of support to the economy. So that's all really helping to maintain these gains that we saw last year.
Now, it's also the first business day since the UK officially left the European Union after just managing to work out a deal before end of year deadline. But what kind of changes can be expected?
Well, there already have been some pretty significant changes that took place on January 1st. For businesses, that meant that they were now subject to customs and regulatory changes. So if you're, for example, an exporter, you now have to do customs documents if you want to export to the UK, the same for the UK to the EU. So there is a lot more paperwork that these businesses are now facing. There had been some concerns that we would see British ports in particular really be clogged up and having a hard time dealing with all of these new requirements. We haven't seen that so much so far, but that's something investors and economists and politicians are certainly watching for over the course of this week as trade volume begins to pick up from the holidays as well. UK and EU citizens can no longer travel freely between these borders. We've seen that create a bit of a headache for some expats, some British expats trying to go home to Spain over the weekends. Many of them were not allowed to board their flights, and that had been quite stressful for many expats from the UK. But one of the biggest questions, especially here on the markets, is what's going to happen with financial services. This wasn't included in the trade deal that the UK and the EU reached at the end of last month. So that leaves a lot of traders, a lot of investors, and a lot of banks, financial institutions not really knowing what access is going to be like in the coming months. The EU and the UK have said they want to reach a deal on financial services to ensure that banks continue to be able to operate, but they haven't gotten there yet, and it likely will be quite difficult to iron out some of these issues. So that's still one outstanding question that many investors and financial professionals are worried about.
While we wait to see if we'll get answers to those questions, give us a quick update on the coronavirus situation in Germany. Have lockdown measures and the vaccine rollout managed to slow the outbreak?
That's been the big question. It's quite difficult to tell right now what's happening in terms of the number of infections, because over the holiday period, we have seen the number of new cases come down quite a bit. But that, of course, is likely due in part to things like people not getting tested over the holidays, some disruptions and delays to the reporting of numbers. So it's quite noisy, this data that we're getting now that's showing a decline. And we have already seen the vaccine rollout begin about a week ago. It is starting to pick up speed. Care homes, the elderly, frontline healthcare workers are being the first to be vaccinated, but there will be, of course, limits on how many people can be vaccinated as we try to secure more and more doses for the vaccine. But all of this leaves Germany really in the same place that it was a month ago, and we have already seen federal politicians and state politicians agree to extend the lockdown that Germany's in until the end of the month. So really no reprieve for now from the current coronavirus situation.
All right, Chelsea, thank you. We'll see you again tomorrow. Now, shares in London have risen sharply on the first day of trading in 2021 amid optimism stemming from the rollout of the second coronavirus vaccine. Juliana Olayinka joins us now for more details. Hello again, Juliana. I know you and I have interacted this new year, but it's the first trading day in 2021, so I'm sure that we can still tell each other Happy New Year once again.
Absolutely. Happy New Year, Bissy. Busy. Happy New Year to you.
I could say busy, Juliana, as well. All right, now let's start with the markets getting a very big boost as the Oxford vaccine rollout begins. It looks like a happy way to start the first trading week in the new year, isn't it? Tell us what the numbers are looking like.
Absolutely. It's a great day for the first trading session of the year. Triple-digit gains at early trading, and those gains have been extended at intraday. The Oxford AstraZeneca vaccine rollout is a huge sigh of relief for London investors, particularly as we are seeing record-breaking case infections here in the UK. I believe yesterday over 55,000 people tested positive for COVID-19, even though parts of the country are in Tier 4, which is the toughest restriction restrictions here in the United Kingdom, we are still not seeing those cases reduce. So there are talks, lots of talks that we could potentially be going into a third national lockdown. We are waiting to hear from Prime Minister Boris Johnson, but that hasn't dented the optimism of investors. So we can see at intraday, the FTSE All-Share is up by 2.33%. The FTSE 100 is up by 2.84%, and the FTSE 250 is up by 0.40%. In the currencies market, the British pound is up against the US dollar by 0.05%, down on the euro by 0.63%, and down on the Japanese yen by 0.45%. Worth mentioning, Bissy, that TUI, the package tour operator, their shares jumped 9.8%. Seems their hopes are pegging on this AstraZeneca vaccine that perhaps British holiday makers will be able to fly on their planes once again in a couple of months.
We'll see if that happens. Now, let's talk about this data compiled by the Centre for Retail Research showing the COVID pandemic has led to a 163% rise in restaurant job losses in the UK in 2020. It's a new year, Juliana. What sort of recovery do you anticipate for the hospitality sector, especially with the vaccine rollout now?
Absolutely. Nobody wants to be negative at the start of the year, but it's not looking good for the hospitality sector. As you said, tens of thousands of jobs have been lost in 2020, which is a stark jump from what we saw in 2019, which I believe, according to this data, was about 11,000 job losses. And there have been so many issues, like we've discussed about retail. Before the pandemic, retail was in a state of chaos because e-commerce was just overtaking the amount of people that were going into stores. And we're seeing this with the restaurant business. About 5 years ago, we saw a mass expansion of fine dining and retails, fast hospitality, lots of people going out for cheap lunches during the working hours and after that. And it did become really saturated. So they had issues before that. Then, of course, the hemorrhaging, which was caused by the COVID pandemic. Lots of them thought they could recover because we had August's Eat Out to help out, which did see a surge in the amount of people that were going out trying to socialise with their friends. But then, alas, we have the second national lockdown. And now there are more issues because in tiers 3 and tiers 4, which I believe, according to this data, about 50,000 restaurants up and down the UK are in, they cannot open. They can only open if they are giving takeaway. So this has caused tens of thousands of job losses. And so we are expecting this to continue during 2021, even though the government are trying to help with the furlough scheme, which of course has been extended up until the end of April. It's just not enough. Yes, it is paying for people's wages, but what about the rent? What about, you know, the day-to-day running of these businesses? So such a shame that we're starting the year with such negative data, but it just goes to show that 2021 hasn't seen the end of the fallout of COVID-19.
Oh, another big story grabbing the headlines today, Juliana, is the £8.1 billion offer from US casino giant MGM Resorts to take over Ladbrokes. And we understand that Ladbrokes owner Entain has rejected that offer. Why?
Entain have rejected that offer, and they said they're rejecting it because they don't think the $11 billion offer is just enough. And that's because since the lockdown, unfortunately, depending on the line you sit, online gambling has really surged during 2020. And it has become very lucrative for these big casino giants in the US. And that's because the US government in 2018, they finally made online gambling legal. And so we are seeing a flurry of these massive companies trying to get a piece of the pie. Last year, I believe it was actually on this programme, I was discussing the takeover of William Hill by Caesars Entertainment. They got that for billions of pounds. And now MGM want to do the same for Entain. Entain is a massive organisation. They've got Ladbrokes, they've also got Coral and some other Irish-based firms. Shareholders seem to be happy. As soon as Entain went public with this announcement at about 9:18, their shares rose by 28%. This is the highest daily rise they've seen in about 12 years. But as they said, it's not enough. So who knows? I'm sure in the next couple of days, MGM may put more money in their pocket, and it's likely to be a very lucrative sale for them.
We'll see if that happens, Juliana. Thank you, and do enjoy the rest of your day.
Thank you.
We'll be talking about the benefits of the AfCFTA for Africa when we return in just a moment. Please stay with us. Welcome back. The African Continental Free Trade Area Agreement took off on January the 1st, 2021. And since then, many have welcomed the commencement with excitement and expectations of enhanced business opportunities within an enlarged African continental market. But let's get more on this from the Associate Practice Lead at Frontier View in London, Matt Kindiger. Good afternoon, Matt. Happy New Year. It's good to see you again. Let's start this conversation with you telling us why the implementation of the AfCFTA is so important for the continent.
Well, thanks for having me on the show, and Happy New Year to you as well. Well, yes, getting started. Why is it so important for the continent? So firstly, it's going to be the world's largest free trade area in terms of population. It will be unprecedented in terms of the amount of coordination or the depth of coordination between a large number of African countries. You know, we've never seen policy coordination on this scale before, so this is a really positive development at a continental level. But very crucially, it's pointing towards African economies becoming more orientated towards exporting and trading with each other rather than relying on historical colonial era trade links. So it really is quite important for the trajectory of the economic development of African nations. But crucially, if we're looking at the short-term developments, it's also quite important for the region's recovery from the COVID-19 pandemic. Although we're not going to see a sharp boom or sharp improvement in trade over the short term as a result of the free trade agreement, it probably will incentivize more investment in trade. So this is only a positive thing over the next couple of months.
But in practice, Matt, how soon will businesses and consumers see the benefits from the AfCFTA?
So I think this is a question that a lot of people will be asking themselves, because obviously it's a very big development. It came into effect on the 1st of January, but practically a lot may not have changed for many companies and consumers. So there are unlikely to be overnight improvements in trade. It will take a long time in practice for governments to remove all their tariffs and non-tariff barriers. So it will take a while. And even if tariffs are removed, say tomorrow, there are a number of logistical and practical issues that companies and businesses need to get over or overcome in Africa. So that includes things like pretty bad road connections and rail connections between countries, although we've seen a significant improvement in domestic infrastructure, binational or sort of international travel connections are still quite weak across the continent. We also have things like foreign currency shortages and logistical challenges at things like at import ports. So although generally the direction of travel is positive, in practice, a lot of companies will have to wait a couple of years at least before they see a material benefit from the terms of the trade agreement.
But which countries and industries are likely to be the biggest winners and the losers from the agreement over the coming years?
Yeah, so the longer we look ahead, so if we look to say 2025, 2030, the benefits are going to become much clearer, and companies will start to benefit in countries as well. So assuming there is coordinated trade liberalization, trade barriers falling across the continent, we're likely to first see the large manufacturers of the region, say in Nigeria, Kenya, South Africa, really benefit. We're likely to see companies that produce value-added products rather than raw commodities benefiting the most. But we're also likely to see companies that are involved in logistics and transport as well benefiting as a result of increased intra-regional trade. Consumers, crucially, are also likely to see an increase in choice as well, because most consumers are reliant on either products imported from overseas or products produced domestically. But increased consumer choice is likely to become a feature of most markets over the next couple of years. So generally, it's going to take a while, but it's going to be the really big economies initially, and consumers, logistics and transport benefiting through the 2020s.
Thank you, Matt. Matt Kindiger is the Associate Practice Lead at Frontier View in London. Do enjoy the rest of your day.
Thank you.
In other stories now, South Africans will start paying more for petrol and diesel effective Wednesday this week, and that's according to the Department of Mineral Resources and Energy. The Energy Department attributes the hike to the rising international prices, which offset the benefits of a firmer rand against the dollar. In a reaction, the Automobile Association says while SA fuel prices are well off their record highs, the country's economy is in a fragile state, and any shocks to international oil prices or the rand-dollar exchange rate could hurt fuel users badly. The rand has continued to advance against the US dollar, which is a pleasing outcome considering the severe beating the currency took earlier in 2020. But even the currency's ongoing strength has not been enough to contain oil's march back towards its pre-COVID-19 price levels. Meanwhile, the International Finance Corporation and Nedbank have partnered to increase financing for renewable energy projects in South Africa in an effort to help the country transition to cleaner forms of power, reduce greenhouse gas emissions, and create jobs in the renewable energy sector. It's the third investment dedicated to green finance in South Africa's financial sector. The IFC will provide Nedbank with a loan of up to $200 million to help it expand its green finance operations and grow its climate portfolio by funding renewable energy projects. The partnership is part of the IFC's broader objective to develop South Africa's climate finance market and to support the government of South Africa's plan to shift to a lower carbon economy. Away from South Africa now to Egypt, where the central bank has extended 2 debt relief initiatives for another 6 months, which were launched earlier to help companies and tourism firms struggling as a result of the coronavirus impact on the economy. In a statement released over the weekend, the regulator says the move affects companies with bank debts of less than 10 million Egyptian pounds and tourism firms with debts of more than 10 million pounds. The initiative entails removing the names of these firms from blacklists, removes assets restrictions, and holds legal action. The extension runs through June. The Kenyan government has heightened surveillance at the Namanga border point to curb the spread of the coronavirus. The truck drivers and travelers were subject to COVID-19 testing, while anyone found illegally crossing the border was put on mandatory quarantine for 14 days.
Truck drivers plying the Kenya-Tanzania route complained of massive delays at the Namanga border point in May due to COVID-19 screening and certification. Hundreds of trucks were parked at the border's yards as drivers waited to be cleared. Many of them were frustrated because they had to undergo the same process on the Tanzanian side.
I currently have 2 certificates, one from when I was tested on entry into Uganda at Busia, and another when re-entering Kenya. They do not recognize those here. They say every border point carries out tests. They should just allow passage to those of us who have already been tested and given a clean bill of health. In fact, my certificates are valid for 14 days, and these have not lapsed. This certificate is very slow. It is making us broke. The officers conducting the test come here late and leave very early, and this is costing us. If these delays are going to be the norm, then they should consider closing the border completely.
The crisis shut down the country's vital tourism sector, hammered its fresh produce exports, and severely disrupted other sectors like construction, trade, and transportation. Tanzania's government has been criticized for not providing regular updates on the spread of the outbreak, and the opposition has accused it of being secretive. COVID-19 cases have been recorded at the Namanga border point, which health officials said strengthened their resolve to continue screening intensively.
And that's our program today. Thank you for watching. I am BC Adebayo.